Which FVGs are suitable for entry? Hello! Today we're going to explore together, in simple terms, what an FVG is and why it forms, a real example from the market, and finally we'll understand which FVG zone is the best entry point when multiple FVGs appear consecutively in a trend. So stay with us until the end of the video because there are very important tips hidden throughout the lesson. Before we start, make sure to subscribe to the channel, hit the notification bell, and give us a like to keep us motivated. Now, without further delay, let's dive into the training. FVG, or fair value gap, is an area on the chart where an imbalance between supply and demand is created due to a rapid price movement. This gap is usually formed by three candles, where the body of the middle candle leaves a price range with no trading activity, and the next candle forms with no wick or a very small wick. This indicates that some orders were left unfilled in that area, often as a result of large institutional orders entering the market. This movement disrupts market balance, and price usually tends to return to these areas in the future to fill the remaining orders. As a trader, when you sit in front of the chart, your first task is to identify FVG zones. These zones show where institutions have entered the market, and when price returns to them, you can trade in alignment with smart money flow and potentially achieve strong profits. To better understand this concept, let's go through an example together. Here, you can see the gold chart with the symbol XAUUSD. Price has created an FVG, or imbalance zone, and reacted well when it returned to this area. In the same way, by identifying these zones on the chart, you can open your positions in the direction of the trend.
But the main question many traders have is this: when several FVG zones form consecutively in a trend, which one should we choose as the entry zone? Take a look at this chart. You can identify two FVG zones, but professional traders only enter a trade when the price reacts to this specific FVG. But why? If you mark the beginning and end of this bullish move and apply the Fibonacci retracement tool, you'll notice that this zone lies below the 50% level, which is known as the discount zone, while the first FVG is located above the 50% level. Most professional traders enter in the zone below 50% because not only has the market collected the liquidity needed to continue the trend in this area, but it also allows for a smaller stop loss, which reduces entry risk while offering a higher reward. This same approach works perfectly in downtrends as well.
All right, traders, today's lesson has come to an end. Thanks for staying with us until the very last moment. To make sure you don't miss our upcoming videos, be sure to subscribe to the channel and hit the notification bell so you'll be notified as soon as a new video is released. And as always, your likes give us energy. Bye!